All right, so now we are going to discuss the IPO, initial public offering, and this is going to shed some light. We talked about why companies issue stock. They issue stock to raise money, and the IPO, is the method or the process that they use to raise that money. So let's get into it. So what is an IPO? IPO stands for initial public offering. Okay, an IPO is the first time a company introduces their stock to potential stock investors. Once again, an IPO is the first time a company introduces their stock to potential stock investors. An IPO is the first chance that stock investors get to purchase stock in that particular company. It is the beginning of it all. An IPO is similar to a new product being introduced to the public for the very first time, such as a new model car, a new model computer, a newly built house. Once again, an IPO is like a new product, something that's been introduced to us for the very, very first time. So let's talk a little bit about the process. So you have a business that you started. Right now, it's a sole proprietorship or it's a partnership. It's a privately held company. And now you want to expand and you want to raise more money so you can expand your operations. So you decide that stock is the way that you want to go to raise money. Then they determine an amount that they need to raise, which will determine how many shares they need to issue. They hire an investment bank to buy and sell the shares to the public. They sell the shares to the investment bank. The proceeds from the shares to the investment bank are used by the company to finance operations. And the investment bank sells shares to the general public. So the investment bank is the intermediary between the company and you, the general public. And this process here is, I'm not going to go into the nuts and bolts, but basically how it works is the investment bank actually gives the company the the amount that they're trying to raise. It's not the actual public. So the investment bank basically buys the shares from the company at a discount, and then in turn the investment bank will sell those shares to the general public. So this is a diagram of how money flows and how the shares flow from the corporation to the investor. It shows the corporation sells shares to the investment bank, and then the investment bank in turn sells the shares to the investors. And at this point, the stock is in the market or in the public. And it shows the money trail where the investor pays cash to the investment bank, and in turn, the corporation receives cash from the investment bank. And I included this diagram because it's very similar to how a car manufacturer introduces new model cars to the market. Just when you're trying to get a new car, you don't call or talk to Ford manufacturing. Try to call Ford manufacturing and tell them, hey, I want an F-150 2000 quad cab or whatever. They're going to tell you, hey, you need to talk to one of our dealers. That's the only way that you can purchase that car. Okay, so the car manufacturer sells new models to the car dealer. The car dealer in turn sells a new car model to the consumer. At this point, that new car model is in the market or in the public. It's with us now. And in turn, the car dealership receives cash from the consumer. The consumer pays the car dealer, and the car manufacturer receives cash from the car dealership. And so that's how the relationship works. And it's very similar to how an initial public offering works. And this is a second look. Corporation sells shares to the investment bank. Investment bank sells shares to the investor. Investment bank receives cash from investors. Corporation receives cash from the investment bank. And the investment bank acts as an intermediary. So let's look at how stock and cars change hands after the IPO. The investor who who decides that hey, I don't want this stock anymore. If they want to sell it, they usually will have to go through an investment bank or a stockbroker, an intermediary, and they'll sell it to another investor who wants it. And the cycle goes on and on and on. And notice that the corporation is not in the equation at all. The company's not in the equation at all. The transactions are totally between an investor and another investor. Stock is sold by investors to investors through an investment bank or stockbroker. The same situation is very similar with cars. You buy a car from a dealership. If you decide, hey, I want to trade it in, you have to go back to the dealership, another dealership, to trade it in, and then that dealer will in turn sell it to another consumer who wants your car. And notice that the car manufacturer is not in the equation. Once the car is in the market, the transactions are occurring between consumers, or the car is sold by consumers to consumers through a car dealership. The car dealership acts as an intermediary. And this is a myth that people think that companies receive money from stock after the IPO. And this is absolutely not true. The only time companies get money from stock after the IPO is when they issue another stock offering or a secondary offering. Okay? So let's look at this for a second. Let's say that a company issues 5,000 shares to raise $1 million during an IPO, the initial public offering. At this point, there are only 5,000 shares out in the public. Okay, so let's say after a couple of years, the company decides, hey, we want to build another factory. We want to add some more square footage to the building. So they say, hey, let's raise another 1 million. So they issue another 5,000 shares, a secondary offering, to raise another $1 million. So at this point, they have raised $2 million from two separate stock offerings, and they have 10,000 shares outstanding. So the only time that they received more money was after they issued more stock. So some key points to remember about the IPO is that the IPO is the first time a company introduces their stock to the public. Companies use an investment bank to get shares to the public. Companies do not receive any money from their stock after the IPO.